Dan, welcome. I guess you're not too surprised to see the market mood shift. You've been pretty bearish. What is your take on the inflation report?
I mean, there's no way to look at it other than it's negative. I mean, CPI is up 8.5%. Core is up 6.5%. You're at 40-year highs, and the Fed has raised rates once. So the Fed is incredibly far behind. It's the farthest the Federal Reserve has been behind since the 1970s. And so you're going to see multiple 50 basis point rate hikes. You're going to see the balance sheet work down. And I think the key is when you're thinking about this market, you want to stay big picture. If it was don't fight the Fed on the way up, which was they put in so much stimulus that the stock market rallied over the 2 years we had a global pandemic, then the same applies on the way down, which is don't fight the Fed. The second part of it is you don't want to fight the fundamentals, which is that earnings estimates are going down for the first time since 7 quarters ago during the depths of the pandemic, because you do have things like inflation and energy costs and wage increases, and the biggest thing, which is demand slowing down. So those are the two big things: don't fight the Fed and don't fight the fundamentals.
So there is another way of looking at it today, though, when it comes to the inflation report, Dan, which is how the market saw it earlier, which is that it may be peaking. We saw core CPI, for instance, only rise 0.3% in March. And I say only because that is a deceleration from what we've seen in prior months. And there is a thinking that if inflation comes down sooner rather than later, the Fed won't have to be as aggressive, and those beaten down tech stocks might not look so bad.
Yeah, I think that's a very optimistic way to view things because, yes, I mean, mathematically, the compares get a lot tougher for inflation as you move out over the next few months. The problem is that 2/3 of all costs for corporations are related to wages. And you've got 3 million more job openings than you have people unemployed. The Fed can't fix that with rate hikes unless they magically make 5 million people show up on this planet to work in the United States. So that's not going to fix anything. And supply chain and energy costs are only 20% of corporations' expenses because we're a services-based economy. This isn't like 200 years ago. So those things are going to continue, and then you're going to have food inflation, which is going to be really high towards the end of this year because the Ukrainians are involved in something else rather than planting, which means they won't be able to harvest. So it's going to be pretty bad, and it's going to, obviously, inflation should come down from 8.5%, but it's still going to be way higher than what people think by the end of the year. I think it's still going to be above 4% by the end of the year, which is still too high.
So what is your strategy then? Is it to raise cash during rallies? I know cash was one of your big calls of the year, which has been a good one. Is that still the strategy here?
Yeah, for us, I mean, I do this every day. So the strategy is pretty simple. We tweet about it, which is, when the market really sells off and gets super oversold, then we cover and we try to get long. When you get a rally that gets back 70% plus of the prior leg lower, we go ahead and we start to reshort again. And we'll change that if we think, inflation comes in way lower than what we're thinking or demand hangs in a lot better. But right now, that's not the case, and valuations are still high. So I think if you're a retail viewer and you can't watch a portfolio every day, cash is still the best. Otherwise, that's kind of the strategy that we're employing.